Hi everyone, I'm Mani, the founder and CEO of Valur. In this video, we'll explain how individuals are taxed on the distributions they receive from a charitable remainder trust. As to really understand the value of a charitable remainder trust, it's critical to understand how charitable remainder trust accounting works and what is the impact of that on your taxes. So let's jump into it. At the simplest level, your distributions from a charitable remainder trust are taxed in the same category as the income would have been if you had sold the assets yourself. For example, if you sell stocks inside of a CRT that would have qualified as long-term capital gains, you would pay long-term capital gains when you receive your distributions from the trust. Pretty simple, right? And at the highest level, a charitable remainder trust is a true tax deferral structure. It doesn't change the tax nature of the income. It just delays when you pay the taxes, allowing you to delay those taxes and reinvest that money to create more wealth for yourself. However, there are some charitable remainder trust accounting nuances that do impact the distributions and are important to understand. Charitable remainder trusts have their own accounting rules. It's called the four-tier accounting. And at the highest level, what that means is when distributing income from the trust yourself, the trust administrator, such as Valur, has to distribute income from the highest tax rate categories first and end with income categories that are at the lowest levels. What does this mean in even simpler terms? Your distributions from a charitable remainder trust are distributed essentially on a worst out first basis. Highest tax income first, lowest tax income last. Now, as a side note, the four-tier income category that charitable remainder trusts follow are really 8 tiers due to IRS nuances. So we'll go through each of those 8 tiers. And as a reminder, the first tiers we mentioned, that income is distributed first. So tier 1, and the first that's distributed, is ordinary income. Today's world, that's usually interest income from bonds, crypto, or private debt. When you receive those distributions, you pay ordinary income tax rates. Tier 2 is dividends from qualified stocks. So essentially stocks or ETFs that you've held for more than a year. Tier 3 is short-term capital gains. Essentially the capital gains from assets that you've held for less than a year. Tier 4 is from the sale of collectibles such as sports memorabilia, art, or NFTs. Tier 5 is income generated from the sale of real estate property that is tied to depreciation recapture, i.e., when the sale price of an asset is above the adjusted cost basis due to claimed depreciation. It's the least likely to happen in here. Tier 6 is from long-term capital gains, basically assets that you've held for more than a year. Tier 7 is from tax-free income categories such as QSBS or tax-free bonds. And the last tier, tier 8, is return of principal, or the cost basis of the assets used to fund the trust. As you can see, charitable remainder trusts have a bit of a more complicated accounting than you're used to with your normal taxes. At Valur, we include this as part of our services to make things simple for you. And we also leverage our expertise to help you maximize your proceeds by taking advantage of these rules and nuances to really maximize what you're taking home and minimize the tax impact. I really hope you found this video useful. Please let us know any questions or comments you have below. And a quick word about Valur. We built a platform to give everyone access to the same tax and wealth building tools that billionaires like Facebook founder Mark Zuckerberg use. We make it simple and seamless to pick the best strategies, set up, and administer these structures at a fraction of the cost of competitors. If you still have any questions, you can visit our website at Valur, Valur.io, where you can read our in-depth content, play with our online calculator to see what are the potential gains you could take advantage of, or set up a call with one of our trust experts to learn more.